Welcome back to your channel name, the place where we break down the wild, sometimes scary, but oh so exciting world of money and investing. Today, we're diving deep into the stock market. Think of it as the ultimate financial jungle. It's thrilling, it's full of opportunities, but oh boy, it's also packed with traps that can gobble up your hard-earned cash faster than you can say bull market. Don't worry though, we're here to guide you through the jungle, help you avoid the quicksand, and maybe even find some treasure along the way. In this video, we're talking about understanding the stock market, common mistakes to avoid. We're going to unpack the biggest blunders new investors make, share some epic stories of entrepreneurs who've conquered the market, and give you practical tips to keep your wallet happy. This is going to be a long one, about an hour and a half, so grab a snack, maybe some popcorn, and let's get started. All right, let's start with the basics. If you're new to this, the stock market might sound like some fancy Wall Street thing where people in suits yell at each other. But it's actually pretty simple. Imagine you and your friends start a lemonade stand. It's doing awesome. People are lining up for your zesty lemon-lime combo. But to make it bigger, you need cash to buy a fancy juicer, hire more friends, and maybe open a second stand. So you sell little pieces of your lemonade empire to people. Those pieces, they're called stocks. And the stock market is just the place where people buy and sell those pieces. When you buy a stock, you're buying a tiny piece of a company, like Apple, Tesla, or even that cool new startup making plant-based burgers. If the company does well, your stock's value goes up, and you're smiling all the way to the bank. If it tanks, well, you might be eating instant noodles for a while. The stock market is where all this buying and selling happens, and it's open to anyone. Yes, even you. Now, before we dive into the mistakes, let's set the stage. The stock market isn't a get-rich-quick scheme. It's more like planting a tree. You water it, you wait, and with some luck and smart moves, it grows into a money tree. But a lot of people trip over the roots before they even get started. So, let's talk about the 10 biggest mistakes new investors make and how to dodge them like a pro. All right, buckle up. We're about to go through the top 10 mistakes that can turn your stock market adventure into a financial horror story. For each one, I'll break it down, share a real-life example, and give you tips to avoid it. Ready? Let's do this. Picture this. You're at a buffet, and instead of checking what's in the dishes, you just pile random stuff on your plate. Some of it's delicious, but some of it's, well, let's just say it's not your vibe. Investing without research is exactly like that. Mistake number 1 is not doing your homework. A lot of newbies hear a hot tip from their cousin's friend's barber and throw all their money into a stock without knowing what the company does. Spoiler alert, that's a recipe for disaster. Let's talk about a real-life example. Back in the early 2000s, a company called Enron was the darling of the stock market. Everyone thought it was unstoppable, until it turned out they were cooking the books. Investors who didn't dig into Enron's financials lost billions when the company collapsed. Ouch! Here's the fix. Research, research, research. Before you buy a stock, learn about the company. What do they sell? Are they making money? Check their financials. Things like revenue, profit, and debt. Websites like Yahoo Finance or Google Finance are great places to start. And don't just trust a random tweet or a TikTok video hyping a stock. Do your own digging. All right, mistake number 2, chasing the hype. Ever heard someone say, this stock is going to the moon? Maybe it's a meme stock like GameStop in 2021, where Reddit forums and X posts sent it skyrocketing. It's tempting to jump in when everyone's talking about a stock, but that's like trying to catch a runaway train. It's risky, and you might get left on the tracks. Here's a story to inspire you. Let's talk about Cathie Wood, the founder of ARK Invest. She's a rock star in the investing world, but she doesn't chase hype. Instead, she focuses on companies with big potential in tech and innovation, like Tesla or CRISPR Therapeutics. Back in 2014, when Tesla was still seen as a risky bet, Cathie's research told her it was a game changer. She invested early, and her funds made huge returns when Tesla's stock soared. Her secret? Sticking to her strategy and ignoring the noise. The fix? Don't follow the crowd. If a stock is all over social media, it might already be overpriced. Look for companies with strong fundamentals, those boring numbers like earnings and growth potential. And if you miss the boat on a hot stock, that's okay, there's always another opportunity. Mistake number 3 is a classic. Putting all your eggs in one basket. Imagine you've got $10,000 to invest, and you dump it all into one company because you're sure it's the next big thing. Then, poof! That company hits a rough patch and your savings are toast. Diversification is your best friend in the stock market. It's like having a backup plan for your backup plan. Let's look at Warren Buffett, the Oracle of Omaha. He's one of the richest people on the planet, and his company, Berkshire Hathaway, owns pieces of tons of businesses. Think Coca-Cola, Apple, and even insurance companies. Warren's secret? He spreads his investments across different industries so that if one takes a hit, the others keep him afloat. When he started investing in the 1950s, he didn't just bet on one stock. He built a portfolio that could weather any storm. The fix? Diversify. Spread your money across different stocks, industries, and even asset types like bonds or ETFs. A good rule of thumb is to have at least 10-15 different investments. That way, if one stock flops, you've got others to keep you smiling. Oh, if I could just buy low and sell high every time, I'd be chilling on a yacht right now. Mistake number 4 is trying to time the market. A lot of new investors think they can predict when a stock will hit rock bottom or skyrocket. Spoiler, nobody has a crystal ball, not even the pros. Take Peter Lynch, the legendary manager of the Fidelity Magellan Fund. In the 1980s and 90s, he turned a $20 million fund into over $14 billion. His secret? He didn't try to time the market. Instead, he invested in companies he believed in for the long haul, like Walmart and Dunkin' Donuts. Even when the market dipped, he stayed calm and held on, knowing great companies bounce back. The fix: focus on time in the market, not timing the market. Invest regularly, maybe through something called dollar cost averaging, where you put in a fixed amount every month, no matter what the market's doing. Over time, this smooths out the ups and downs, and you're less likely to panic sell at the wrong time. Mistake number 5 is a sneaky one: letting emotions run the show. The stock market can feel like an emotional roller coaster. When stocks are soaring, you're greedy and want to buy everything. When they crash, you're terrified and want to sell it all. But emotions are the worst financial advisors ever. Let's talk about Elon Musk, not as an investor, but as someone whose companies have been affected by emotional investing. In 2020, Tesla's stock was on a wild ride. Some investors sold in a panic when it dipped, while others bought at crazy highs out of FOMO. The smart ones? They ignored the noise, studied Tesla's long-term potential, and held on. Today, Tesla's one of the most valuable companies out there, and those patient investors are laughing all the way to the bank. The fix: stick to a plan. Set clear goals, like saving for a house or retirement, and don't let market swings mess with your head. If you're freaking out, take a deep breath, step away from the trading app, and maybe go for a walk. Your future self will thank you. Mistake number 6 is ignoring fees and taxes. You might think, oh, a 1% fee? No big deal. But those little fees are like termites. They nibble away at your returns over time. And don't get me started on taxes. Selling stocks too soon can trigger a big tax bill that eats into your profits. Here's where we can learn from John Bogle, the founder of Vanguard. He's the guy who popularized low-cost index funds, basically baskets of stocks that track the market. Back in the 1970s, he saw how high fees were killing investors' returns, so he created funds with super low costs. His funds have saved investors billions over the years. Talk about a hero! The fix: choose low-cost investments like index funds or ETFs, and watch out for trading fees on platforms. Also, think about taxes. Holding stocks for over a year often means lower tax rates. Chat with a tax pro if you're unsure, because nobody likes a surprise tax bill. Mistake number 7: following the wrong advice. The internet is full of self-proclaimed stock market gurus promising you'll be a millionaire by next Tuesday. Spoiler: most of them are just trying to sell you something. Whether it's a course, a newsletter, or a secret system, be skeptical. Contrast that with someone like Ray Dalio, the founder of Bridgewater Associates. He's one of the most successful hedge fund managers ever, and he's all about principles, not promises. His book, Principles, talks about learning from mistakes and sticking to a disciplined strategy. He doesn't hype stocks on X. He studies markets and builds strategies that work over decades. The fix: stick to credible sources for advice. Read books by proven investors like Dalio or Buffett, follow reputable financial news, and maybe consult a certified financial advisor. If someone's promising you quick riches, run the other way. Mistake number 8 is overtrading. Some people treat the stock market like a video game, buying and selling every day to chase quick profits. But every trade comes with fees, and constant tinkering can mess up your long-term plan. It's like rearranging your furniture every day, exhausting and pointless. Look at someone like Charlie Munger, Warren Buffett's right-hand man at Berkshire Hathaway. Charlie's famous for his sit on your hands philosophy. He believes in buying great companies and holding them for years, not days. When he invested in companies like Costco or American Express, he didn't flip them for quick cash. He let them grow over decades. That patience helped him build a fortune. The fix: trade less, invest more, pick solid companies, buy them, and let them grow. Only sell if the company's fundamentals change or you need the cash for a big life goal. Patience is your superpower. Mistake number 9 is not having a plan. Investing without a goal is like driving without a map. You might end up somewhere, but probably not where you wanted. Are you saving for a house, retirement, a dream vacation? Your plan shapes how much risk you take and what you invest in. Take Lisa Su, the CEO of AMD. She's not just an investor, but a visionary who turned AMD into a tech powerhouse. When she took over in 2014, AMD's stock was struggling. Her clear plan, focus on high-performance chips for gaming and AI, turned AMD into a market leader, with its stock soaring over 1,000% in a decade. Her success shows the power of a focused strategy. The fix: make a plan. Decide your goals, how much you can invest, and your risk tolerance. Write it down and check it yearly to stay on track. A plan keeps you focused, even when the market gets wild. Last but not least, mistake number 10, giving up too soon. The stock market can be a bumpy ride. When stocks dip, it's tempting to sell and swear off investing forever. But the market rewards patience. Historically, it grows about 7–10% a year on average, but you've got to stick around to see it. Look at Jeff Bezos, the founder of Amazon. When Amazon went public in 1997, its stock was volatile, dipping and soaring for years. Investors who believed in Bezos's vision and held on turned small investments into millions. One share bought at $18 in 1997 is worth thousands today, even after splits. That's the power of staying in the game. The fix: think long-term. Don't panic over short-term dips. Keep investing regularly, stay diversified, and trust that time is on your side. The stock market isn't a sprint, it's a marathon. All right, we've covered a lot of ground. Let's recap the 10 mistakes to avoid. Not doing your homework, chasing hype, putting all your eggs in one basket, trying to time the market, letting emotions take over, ignoring fees and taxes, following bad advice, overtrading, not having a plan, and giving up too soon. Whew, that's a lot. But here's the good news. You can avoid these traps and build wealth in the stock market. First, open a brokerage account. Platforms like Robinhood, Fidelity, or Vanguard are user-friendly. Start small, maybe with $100, and pick a low-cost index fund. Second, set a goal. What are you investing for? Write it down. Third, commit to learning. Read one investing book a month. Start with something like The Intelligent Investor by Benjamin Graham. And finally, be patient. The stock market is a long game, but it's one you can win. Investing in the stock market is like planting that money tree we talked about. It takes time, care, and a little bit of courage, but the rewards can change your life. Just look at people like Warren Buffett, Cathie Wood, or Jeff Bezos. They didn't get rich overnight. They avoided these mistakes, stayed disciplined, and let their investments grow. You can do it too. That's it for today's deep dive into the stock market. If you found this helpful, smash that like button, hit subscribe, and ring the bell so you don't miss our next video. Drop a comment below. Tell us your biggest investing mistake or what you're excited to try next. And if you want more tips on building wealth, check out our playlist on personal finance right here. Thanks for watching, and we'll see you in the next one.